Hello everybody, Alex here, and in today's video I want to talk about something very important that every investor has to think about when investing in a company. Now, a lot of the times as investors, we might go in blind with an investment and not really fully understand why we're investing in a particular company, what we're trying to get out of our investment, and what we should be looking for to best determine if I should go in on an investment or not. Now, let's take a step back and understand really what we're investing in. We're investing in a business. Now, it doesn't matter if we're investing in a publicly traded company or a private company. Now, to better understand the idea of putting our money into a publicly traded company on the stock market, we should be looking at a private company and make pretend that we are going to buy this company as a whole to better grasp what we're investing in. So, when we invest in a company, we want to buy a company. Let's say there's a lemonade stand out there and we want to go up to the kid and say, hey kid, listen, it's you out, me in, I'm going to buy your company, okay? What are we actually paying for our investment? What is it? Is it the stand? Is it the lemons? Is it, of course, all the assets put together? But what we're actually buying is the cash flow that this company generates, right? So we're putting money into the business in order for us to extract more money out into the future as the business goes on. So in essence, I am paying for the cash flow that the business generates to me. Now, when we start thinking about it in those kind of terms, we can see what is actually important when buying a business, right? So I'm going to go to this lemonade stand and I'm going to basically take a look at their books, okay? Hey, tell me how much you make each month to see if my investment is going to be worth it over a long period of time, all right? Is the cash flow that I am going to get as the owner of the company worth it for this amount of investment, okay? If I put $100,000 into the company and that company generates $100 a month, as cash flow to me, well, guess what? That's not a very good investment, right? If I put in $100,000 and the cash flow each month generates to me $10,000, well, then you can very well see then that might be a good investment, right? $10,000, you'll get your money back within a year. So essentially, I am paying to get that cash flow. So now that we understand this concept, we can now translate it to publicly traded companies and understand better why we're investing in it and what we're looking for. Now, before we move forward, Moomoo wants to give away some free stock today. Moomoo is a free trading app, and the great thing about this platform is that they do not accept payment for order flow. You will get access to a lot of data which a lot of other platforms might not have. This could of course help you take on smarter positions. For example, you can see the short interest of a stock, and that of course could be very helpful to you. Now, you can get up to 5 free stocks, each of them worth up to $3,500 by signing up with the link down in the description. Just by using my link down below and signing up, you will get 1 free stock. If you then fund your account with any amount, you will get another free stock. And if you fund the account with $2,000, you'll get another 3 free stocks. So once again, check out the link down in the description and go get your free stocks with Moomoo today. So when you're all there and you're on your apps and you're buying your companies, what is the idea of it? Why are you buying these companies, right? And the idea is to put money in now so that it can generate more money for you in the future. And so we can translate that cash flow that we talked about with the lemonade stand to the free cash flow of the business that we are investing in, okay? Now, when taking a look at these publicly traded companies, you can look at their financials, right? You can look at their income statement, their cash flow. All of these things are out there in the public market for you to take a look at to see if your investments will generate some sort of return for you, or at the best of your ability, try to determine if they will generate a return for you. So again, what are we looking for? We're looking for cash flow. We want that cash flow when we're buying into a business, so we can take a look at something called the free cash flow of a business. Now, to really understand free cash flow, we have to understand our net profit of the company and how that differs from the free cash flow, okay? In essence, when we take a look at the financial statements of a company, we can take a look at their top line and bottom line revenue, which will be what the revenue is, and then bottom line, which would be their net earnings or net profit, okay? Their profit after all expenses are paid, right? They take in money, they have all their expenses paid out, and then you have a profit. Now, that profit that you see there, the net profit, is not actually the cash that they have on hand. All right, this is a very important distinguishing factor when taking a look at the company's balance sheet and to make a determination if this is a good investment or not. because from those earnings, okay, from the net earnings of a company, there are other expenses that you have as a company to keep that going. All right. So if I have a company that sells, again, lemonades, all right, we're going back to the lemonade stand. So this lemonade stand had a very great year. It was a very hot year outside, and they're set up in the desert, so everything is perfect for this perfect lemonade stand, bringing in a lot of cash flow. Okay, they bring in cash, but this lemonade stand has expenses, right? They have to buy the lemons in bulk, and all of these things go in from the top line and get subtracted out to get to the bottom line of the net earnings. Okay, so the profit of the company is everything that you took in minus the expenses. Now, let's say that this lemonade stand had a very big order with a terms of payment of net 30 or net 60, right? So in this case, they are taking in the profit on paper, but they don't actually have that cash, and that cash is maybe paid out through installments or whatever the case may be. So they don't actually have the cash on hand for that. This gets booked in as profit taken in by the lemonade stand, but it is not actually cash. So you can't actually consider that as cash on hand as part of the cash flow. Another thing that you have to think about is the cash flow itself. Once you have paid for the lemons and everything, you still have to keep the business going by maybe the machine that you make the lemonades with is breaking down every month, so you have to replace that. Okay, you have to paint your lemonade stand because the sun beams on it, creates cracks in the paint. I don't know, I'm just making this off at the top of my head, and you have to repaint it every month. So these expenses are to keep that lemonade stand continuously in operation. So that cash that you're getting in after all the profit is in there is being spent to keep the business going. Okay, so there's always other expenses to a business. Now, once all of those are paid out, then that cash that you have nothing else to do with that cash that can be distributed back to your shareholders, okay, is the free cash flow. Right, so once everything is done, this kid is painting and is replacing the machines and is changing their clothes because they're sweaty. All of this goes into the expenses, and once all of that is paid out, left with that cash, nothing else to do with that cash, that is the free cash flow. Now again, jumping back to the model of a publicly traded company, that company has that profit, and that profit is going into things like keeping the business going. This is why you have to take that operating cash flow that you see in a company and minus another line called purchase of property and equipment. This is the line that you see that will keep that company going, okay? And once you subtract all of this out, then you will have the free cash flow of the business, and that's essentially what you are paying for to get in return from the company. Now, the free cash flow itself should be very close to the net income of the company, all right? The net earnings, the profit of the company. The free cash flow should be very close to this number. Why is this important? Well, it's important for a very simple reason. Because if I'm taking in $100 million, okay, for this company's profit, and then I'm spending $90 million to keep it going, well, then the free cash flow is very small compared to what I'm actually taking in, okay? So you might not take a look at this business and say, well, what I'm actually paying for is not a lot compared to what they're making, all right? Hope this makes sense. If the company is bringing in, again, $100 million and they're keeping $90 million from this, then that means that they are paying out only $10 million to keep this company going. This is a very small amount. That means they have that cash flow available to distribute to shareholders. So once that free cash flow is large, it's a large number, especially compared to their net income, then we know this is a good sign because they don't have to continuously pay out a certain amount to keep that business going. So now with that free cash flow, what can be done? Well, there's three things that can essentially be done with a company's free cash flow. And this is all good. The bigger the free cash flow, the more they have, especially percentage of net income, the more potential it has to grow and make you as the investor money. So what can it do? Well, the first thing that you can do is you have the cash flow, nothing else to do with it besides investing back into the business to grow. R&D and expansion and hiring new people and developing the products, right? And growing that business. So this is why a lot of growth companies take their cash flow, they put it back into the business to grow. And this way, you as the investor will make money off of the capital, the appreciation of the stock, right? The appreciation of the company's growth for you to make money, right? Another thing they could do with that is give money back to the shareholders in a form of a dividend, right? So they decide that this company is better, the free cash flow is better spent back to the investors by putting in a dividend payment to them for owning the stock, right? And this is all the stuff that you can do by having a good cash flow, right? And then the last thing they could do is buy back shares. Now, when a company buys back shares less than the intrinsic value of the company, this is good for shareholders, right? If they're paying more than the intrinsic value, then that's going to dilute your shares and effectively not be good for you as shareholders, okay? So that's a very important distinguishing factor when looking at when companies buy back shares. These three things are very important when you have cash flow, good cash flow in a company. So when you see a company with good cash flow, you know that they're going to grow the company. They have good potential to grow the company. They're going to pay dividends, right? Or good, at least the idea of paying dividends is there. So maybe you have a dividend increase if you see the free cash flow increasing and if they're known to pay dividends, all right? So all of this is in your decision-making process. They could buy back stock, right? And that's good for the shareholders. So now when you see a company with good cash flow and you know that what this cash flow means, then you can have a better understanding of how this company will grow and the potential of it growing, all right? So now when taking a look at that free cash flow, if you see that free cash flow increasing quarter after quarter, year after year, then we know that the company has potential for growth in those three areas that we spoke about. And if the company has potential for growth, and if you invest in it, the idea is you're investing now to get more growth later on, and this means that your investment will grow as well. So there you have it, something very, very important for any investor to look at when investing in a company, both privately, but more so, I think, publicly, to understand that, right? Once you understand that, you could better understand why I'm investing, what I'm hoping to get out of my investment, and what to look for in the financial statements, because I know it could be very daunting to go through all the numbers and everything. If you want to stick to one number, take a look at free cash flow, and I think you'll make better investing decisions along the way. So thank you all so much for watching. Hit that like button if you liked this video and learned something. Subscribe if you haven't already, and we will see you very shortly on the next video.